I want you to imagine a scenario. It's a classic setup. You have an idea. And not just a wouldn't it be nice kind of idea, but a burning, keep you up at night idea.
The kind that you're scribbling on napkins at 3 in the morning.
Exactly. Maybe it's a cooler that has a built-in blender for, beach margaritas. Maybe it's a video game that simulates an entire living galaxy. Or maybe, and this is a real example, you simply want to make the world's best potato salad.
The potato salad example is actually crucial here. Do not underestimate the potato salad.
Oh, we're definitely getting to the potato salad later. But here's the reality check. Traditionally, if you wanted the money to make that idea real, you had a very specific, very narrow path.
A very intimidating path.
Totally. You had to put on a suit, probably an uncomfortable one, walk into a bank, and sit across from a loan officer. And you had to convince this one person, who essentially holds your fate in their hands, that your potato salad was a viable business model with a projected ROI.
Or, if you were in the tech world, you were pitching to venture capitalists on Sand Hill Road. And, they generally only care about one thing. Is this going to give me a 10x return? Can this be a unicorn?
Exactly. It was a gatekeeper model. A centralized model of finance where a tiny, tiny group of people with money decided what the rest of the world got to see, use, or play.
It was high friction, high barriers to entry, and usually a massive allergy to risk. If it didn't fit the standard box, it didn't get funded. End of story.
But now I want you to flip the script. Delete the bank manager. Delete the boardroom. Instead, imagine a swarm. Thousands, maybe tens of thousands of strangers on the internet.
A crowd.
And they don't want equity necessarily. Maybe they just want a taste of the salad, or they think the pitch video is funny, or they just believe in the mission. They each throw in $10, $20. Suddenly you have capital, you have a market, you have momentum.
And crucially, you have bypassed the traditional financial intermediaries entirely. You have, in a sense, democratized the capital raise.
Today, we are doing a deep dive into crowdfunding. But, and I want to be very clear about this right up front, we are not just talking about buying cool gadgets on Kickstarter. That's the surface level. That's the tip of the iceberg.
Right. Because when you really look at the stack of articles and reports we have here, crowdfunding has morphed into something much more significant. It's reshaping how we build skyscrapers, how we fund scientific research, how we pay for high-stakes lawsuits, and perhaps most concerningly, how millions of people are paying for basic healthcare.
We have a massive stack of reports, historical data, and case studies to get through today. We're going to look at the history, which, spoiler alert, goes back way further than the internet. We're going to break down the different weird and wonderful mechanics of how it works, look at the biggest successes and failures, and then really get into the ethics of it all.
It's a huge topic.
It is. So let's unpack this. What exactly are we dealing with when we say crowdfunding?
At its core, the definition is pretty simple. It is the practice of funding a project or venture by raising money from a large number of people, typically, but not always, via the internet.
Okay, simple enough.
Yeah, and it's considered a subsector of crowdsourcing, and it falls under this big umbrella term of alternative finance.
Alternative finance. It makes it sound so underground, like we're meeting in a parking garage to exchange briefcases full of cash.
Well, it used to be a bit fringe, but the numbers are just staggering now. I was looking at a report that showed, as far back as 2015, over $34 billion was raised worldwide through crowdfunding.
$34 billion in 2015.
Yeah, and the projections for the future are even more wild. Some suggest that by 2025, the industry could reach $1 trillion.
Trillion with a T.
With a T. So while we might think of it as a way to buy a cool backpack or a board game, structurally, it is becoming a real pillar of the global economy. It connects the project initiator, the person with the idea, directly to the crowd, usually through a platform that mediates the exchange for a fee.
So it effectively removes the friction of distance and the friction of, institutional approval.
That's the key. It removes the gatekeepers.
Okay, so before we get into the trillion-dollar industry it is today, let's rewind. Because I think most people, and I'll admit, myself included until I read these notes, assume this whole thing started with Kickstarter or maybe Indiegogo in the late 2000s.
That's the common perception, yeah.
But you found some evidence that the crowd has been funding things for a very, very long time.
Much longer. The term crowdfunding is new. It was only coined in 2006 by a guy named Michael Sullivan. But the behavior, that's centuries old. If you look at, for example, the subscription model for books in the 17th and 18th centuries, that was essentially crowdfunding.
How did that work exactly? Was it like a pre-order?
Pretty much. An author, let's say Alexander Pope, translating the Iliad, would say, I intend to write this volume. He'd advertise it in pamphlets and newspapers. And people would subscribe. They'd pay up front to provide the confidence and, more importantly, the capital to get it printed.
So it established that a market existed before the hard work of printing actually happened. It de-risked the whole project for the publisher.
You got it.
Yeah.
It's the exact same principle as a modern campaign.
Mm-hmm.
Prove market demand before you manufacture.
That's amazing. It's like a pre-internet Kickstarter for literature.
Yeah.
But my favorite historical example that we found in the research, and this one really blew my mind because I walk past it all the time, has to be the Statue of Liberty.
This is the classic case study. It really sets the stage for everything that comes later. It has all the same elements.
So paint the picture for us. It's 1885. The Statue of Liberty is a gift from France, right? Everyone knows that part.
Right, a gift from the French people to the American people.
But the deal was, France builds the statue, and America has to build the pedestal she stands on.
A seemingly fair trade, you bring the statue, we'll bring the big stone block kind of
Well,
deal.
sure. Except the statue is on its way. It's literally sitting in crates in a warehouse in Paris, ready to ship. But construction on the pedestal stalls, there's just no money.
And it was a political mess. The governor of New York refused to use city funds. He actually blocked it. And Congress couldn't agree on a federal financing package. It looked like the statue was going to end up in pieces in a storage warehouse, or maybe even shipped back to France.
Imagine the humiliation, a massive symbol of freedom, and we were too cheap to build the base. It's almost comical.
It's deeply ironic. And that's when Joseph Pulitzer steps in. Yes, that Pulitzer. He owned the newspaper The World. And he decides to launch a campaign in the paper. He basically says, we aren't waiting for the millionaires or the government. The people are going to build this.
And he used a very modern crowdfunding tactic, didn't he? He offered a reward.
He did. It was recognition. He promised to publish the name of every single person who donated, no matter how small the amount. Whether you gave $1 or a dime, your name was going in the paper.
And it worked. I mean, it didn't just work. It was a massive success. They raised over $100,000.
Which, in today's money, that's roughly $2 million. So
Yeah.
It was a serious amount of capital.
But here's the stat that I love, the one that I think defines this whole episode. 160,000 people donated.
Which implies the average donation was incredibly small. We're talking cents, not dollars.
That's it. We're talking about waiters, children, regular folks sending in 15 cents or $1. It wasn't a few rich guys writing big checks. It was a tidal wave of pocket change.
And that democratized the ownership of the monument. It wasn't built by a tycoon, it was built by the crowd. And that psychological buy-in is something we still see today. When people fund something, they feel a sense of patronage, of ownership. They aren't just consumers, they are builders. They own a piece of the story.
You know, we also saw this with war bonds, right? The principle is similar.
Theoretically, yes. War bonds are essentially crowdfunding military conflicts. You are asking the public to lend money to the government to fund a war, usually based on a strong patriotic appeal.
And we found other examples, like Cairo University in 1906.
Yeah, that was a fascinating one. Mustafa Kemal, a nationalist leader, ran ads in a newspaper asking specifically for donations to start a university to help pay off national debt. School children donated, farmers donated. It's the same impulse.
And then there's Auguste Comte, the French philosopher. This one feels very modern, almost like a Patreon.
Totally. In 1850, he actually issued notes to the public to support his work. He was essentially crowdfunding his own life and philosophy. He sent out circulars asking for support from his followers. It's not so different from a creator today having a Patreon to support their video essays or their art.
So the impulse has always been there. We like supporting things we believe in, but the internet obviously changed the scale. It removed the friction. When did that digital switch really flip?
There are a few key moments, and the music industry was actually a huge pioneer here. In 1997, the British rock band Marillion couldn't afford to tour the U.S. Their label wouldn't fund it.
Okay, a classic problem for a mid-level band.
Right, but their fans, and this is the amazing part, without the band even asking, initially organized an internet campaign and raised $60,000.
Wait, the fans organized it themselves? How?
Now, through online mailing lists and early internet forums, they just did it. The band eventually heard about it, accepted the money, and used it to tour. It was a massive light bulb moment for the industry. They realized, we don't need a record label to front us the money. Our fans will do it.
That is the power shift. It completely cuts out the middleman.
Exactly. Then you have the software world. In 2002, there was the Free Blender campaign. And we're not talking about a kitchen appliance. We'll get to that later. This was for 3D modeling software.
Ah, Blender. I know that one. It's huge now.
It is, and this campaign is why. They raised 100,000 euros to buy the source code from the original investors and make the software open source forever. That was a huge precursor to the platform era. Then ArtistShare launched in 2001, which is often cited as the first dedicated crowdfunding platform for musicians.
And then the big ones came along.
Then the floodgates opened. Indiegogo in 2008, Kickstarter in 2009, and GoFundMe in 2010. That's when it really went mainstream.
Okay, so that brings us to the modern era. And this is where it gets really interesting because I think people tend to lump all crowdfunding into one big bucket. I give money, I get a thing.
Right, the Kickstarter model.
Yeah, but looking at the breakdown from the Crowdfunding Center and other sources, there are actually several distinct models here, and they work very, very differently.
Precisely. If you want to understand the economics and the social impact of this, you have to separate them. The most visible one, the one we all know, is reward-based crowdfunding.
Okay, so that's your Kickstarter, your Indiegogo.
Right. You are essentially pre-selling a product or a service.
No.
You aren't giving away equity in your company, and you're not taking on debt. You're making a promise. If you give me $50 now, I will send you this really cool smartwatch when it's done.
And the backers here aren't really investors in the traditional financial sense. They don't own a piece of the watch company.
No, they're early adopters. They're fans. They're patrons. And geographically, this is fascinating, the funding doesn't rely on location. You could be in a garage in Ohio raising money from people in Tokyo, Seoul, and Berlin.
But the research shows nothing interesting there, right? Even with that global reach, it still clusters.
It does. Funding still tends to track with traditional finance hubs. Silicon Valley, New York, London. There's a network effect. But the barrier to entry is just so much lower.
Okay, so that's rewards. Then you have equity crowdfunding. This feels like the grown-up table.
This is the high-stakes table, for sure. Here, backers actually receive shares of the company. They become part owners.
And this was a massive shift in the U.S., largely due to something called the JOBS Act of 2012.
Yes, the Jumpstart Our Business Startups Act. It was a complete game changer.
Why was the JOBS Act such a big deal? What did it change?
Well, before the JOBS Act, you generally had to be an accredited investor to buy into private companies and startups.
Which basically means you have to be rich, right?
Essentially, yes. You had to have a net worth of over $1 million, excluding your house, or an annual income over a certain threshold. The government's logic, was that startups are incredibly risky, and they wanted to protect regular people from losing their life savings on a bad bet.
Which sounds reasonable on the surface.
It does, but it also meant that all the potential upside of early-stage investing was reserved for the wealthy. The JOBS Act changed that. It allowed unaccredited, meaning regular investors, to buy equity in startups through regulated online platforms.
So I, a regular person, can own a tiny slice of the next potential Facebook or Google.
Theoretically, yes. And that's the dream they sell. But this comes with a huge economic concept called information asymmetry.
Okay, let's unpack that term. Information asymmetry. It sounds very academic.
It does. But it's a really simple idea. It just means one party in a transaction knows a lot more than the other party. In this case, the person asking for money, the founder, knows way more about the risks, the technology, and the real potential of their business than the person giving the money.
So if I buy a stock on the New York Stock Exchange, that company has to file massive audited reports with the SEC. I can see their books.
Exactly. There's a baseline of transparency. In equity crowdfunding, you're investing in a private startup. They might not have books yet. They might just have a pitch deck and a prototype. You are fundamentally trusting the founder's story.
You're flying blind compared to a Wall Street trader.
You really are. And the risks are so much higher. In reward-based crowdfunding, the worst-case scenario is, you don't get your cool watch. In equity crowdfunding, you're investing in a company that's very likely to go bankrupt, and your equity goes to zero.
So how do platforms deal with that risk?
Well, one mechanism that's evolved is the syndicate model. You'll see this on platforms like AngelList. A lead investor, someone who is experienced and knows what they're doing, puts in their own money and does the heavy lifting on due diligence.
And then the crowd follows them.
Exactly. They piggyback on the expert's research. It's like copying the homework of the smart kid in class. It reduces the due diligence burden on the individual and provides a signal of quality.
That makes a lot of sense. Okay, next up, there's debt-based crowdfunding, which is also called peer-to-peer or P2P lending.
And this is actually the biggest chunk of the money in many markets. It's less flashy than Kickstarter, but the volume is enormous. In 2014, for instance, something like 75% of all crowdfunding money in the UK and US went through P2P platforms like Lending Club or Prosper.
So how does that work? Is it just like a personal loan?
It's very simple. Borrowers apply online for a loan just like they would at a bank. But instead of a bank using its deposits to lend the money, individual investors like you or me can fund a piece of that loan. You might put $25 into a loan for someone's home renovation, and someone else puts in $50, and so on.
And the investors earn the interest.
Correct. The platform takes a small fee for connecting everyone, the borrower gets their cash, and the crowd of investors gets a return on their money. It's just cutting out the middleman bank.
Okay, now for the really niche ones. The next one is litigation crowdfunding. This one really surprised me. Crowdfunding lawsuits.
Yeah, this is a fascinating and pretty controversial corner of the market. It allows plaintiffs, or sometimes defendants, to raise money for their legal fees.
But there's a twist. Right, it's not just a donation.
No. On platforms like LexShares, for example, investors can actually buy a stake in the potential outcome of the case. If the plaintiff wins the lawsuit and gets a settlement, the investors get a pre-agreed cut of that money.
That sounds remarkably like betting on a court case.
That's the criticism.
Yeah.
It's turning justice into a speculative asset class. The argument for it is that it helps people who can't afford justice to take on big corporations, a classic David versus Goliath scenario. It levels the playing field.
And the argument against it
is that it creates a perverse incentive to sue for profit, not for justice. It could potentially clog up the courts with speculative lawsuits funded by people hoping for a big payday.
a really thorny ethical area. And finally, the Wild West, digital security crowdfunding, ICOs, DAOs.
Right. Initial coin offerings. This is where a project offers its own digital tokens or currency instead of shares or a product. This is all deeply tied to the world of blockchain and cryptocurrency.
We saw this explode a few years ago.
Absolutely. You had projects like Ethereum, which was initially funded this way, and then things like the DAO, which raised a huge amount of money before famously collapsing. It's a highly complex, highly volatile, and often regulatory gray territory.
So we have rewards, equity, debt, lawsuits, and crypto. It's a huge ecosystem. But let's try to ground this in some stories, because you can't talk about crowdfunding without talking about the Hall of Fame, and of course, the Hall of Shame.
Yeah, hits and the misses. And there have been some truly spectacular ones in both directions.
Let's start with what you called the whale, the biggest of them all, Star Citizen.
You cannot ignore Star Citizen. It is a video game, an incredibly ambitious space trading and combat simulator that launched a Kickstarter campaign way back in 2012.
2012, that's a long time ago in internet years.
It is. They raised a couple of million on Kickstarter and then moved the funding to their own platform. As of early 2025, public funding trackers indicate it has raised over $900 million.
$900 million. That's more than the budget of most Hollywood blockbusters combined. That's major corporate acquisition territory. And it's all from gamers.
Pretty much all from individual backers buying digital spaceships, some of which cost hundreds or even thousands of dollars.
But here is the catch, right? It's been over a decade, and the game is technically still in alpha. It hasn't had a confirmed full release date.
That's the core of the controversy. So, is it a massive success or a colossal failure?
That is the debate. Critics call it a perpetual crowdfunding model. They argue it's suffering from massive scope creep. They keep adding features instead of finishing the core game. Every time they raise more money, they promise more things, which delays the game, which means they need to raise more money to keep the lights on.
It's a vicious cycle from that perspective. Some have called it a scam, though that's a strong word.
But the supporters would say what?
The supporters, and there are millions of them, would argue that they are already playing it. They get regular patches, new ships, new planets to explore. They see it as a live service that is funded as it goes.
Yeah.
It completely challenges our very definition of what a finished product is in the gaming world.
It's fascinating. It's almost like the development of the game is the game for its community. Okay, so on the flip side of a high-tech, billion-dollar space sim, you have potato salad.
Zach Danger Brown.
Yeah.
2014. A legend.
This guy goes on Kickstarter, and his pitch is literally, I'm making a potato salad. He said he hadn't decided what kind yet. His funding goal was $10.
That was it. That was the entire pitch. He didn't have a business plan. He didn't have a grand vision for a potato salad empire.
Mhm.
He just wanted to make a salad.
And he raised $55,492.
$55,000.
Why? Why did nearly 7,000 people give this man $55,000 to make salad?
Pure entertainment value. It went viral. It became a meme. People wanted to be part of the joke. The stretch goals were hilarious, like, I'll say your name out loud while I make the salad.
Yeah.
It proved that crowdfunding isn't just about utility. It's about community, humor, and performance art.
And he actually followed through, right?
He did. He threw a massive public party called Potato Stock 2014 with 3,000 pounds of potatoes. He donated a significant amount of the money to charity. It showed that people will pay just to be part of a moment.
But then you have the cautionary tales, the ones that go wrong. And the poster child for that has to be the coolest cooler.
Oh, the coolest cooler. This is the classic example of the curse of success. It was an all-in-one party cooler. It had a blender, Bluetooth speakers, USB chargers, the works.
It sounds awesome, actually. I'd want one.
A lot of people did. They set a goal of $50,000. They raised over $13 million. At the time, it was one of the biggest Kickstarter campaigns ever.
Which sounds great. If I raised $13 million, I'd be celebrating.
It sounds great until you have to actually manufacture and ship 60,000 complex electronic coolers with built-in blenders to people all over the world.
The logistics must have been a nightmare.
A complete nightmare. They massively miscalculated the costs. The cost to make and ship each unit was actually higher than the price they charged the early backers on Kickstarter.
Oh no, so every cooler they shipped, they lost money.
Exactly. They ran out of cash. The company eventually went under. Many of the original backers never even got their coolers. It highlights a key risk. Knowing how to create a viral marketing campaign is not the same skill as knowing how to run a global logistics and manufacturing chain.
A really painful lesson for a lot of people. And then there's the even darker side, quackery.
This is a really serious issue. Platforms like GoFundMe and Indiegogo have been heavily criticized for hosting campaigns for unproven or disproven medical treatments.
You're talking about things that aren't just experimental, but are known to be ineffective or dangerous.
Yes. We're talking about costly, fraudulent cancer treatments, things like coffee enemas or dangerous black salve treatments.
Wait, coffee enemas?
Yes. Desperate people, often with terminal illnesses, are looking for any shred of hope. And scammers or misguided practitioners use these platforms to fund treatments that has no scientific basis and can cause real harm.
Which raises big ethical questions about the responsibility of the platform. Are they just a neutral pipe for money, or should they be vetting what gets funded on their site?
That's the million-dollar question, and one the platforms are still wrestling with.
That's a perfect segue, actually, because we've talked about gadgets and games and salads, but the mission of this deep dive was to see how this funding mechanism is applied in more serious sectors. Let's talk about science. Because if people are funding coffee enemas, are they also funding real science?
They are, but it's a very double-edged sword. There are platforms like experiment.com that are dedicated specifically to funding scientific research, and the advocates for this model love it.
What's the argument for it?
It helps early career scientists who might not be able to get traditional government grants, which are incredibly competitive. It also forces scientists to learn how to communicate their work clearly and compellingly to the public, which is a valuable skill.
I can see that, breaking down the ivory tower. But I imagine there's a big catch.
There is. And critics have a name for it, the panda bear problem.
The panda bear problem. I have a feeling I know what this is just from the name.
Think about it. If you ask the general public to fund science, what are they going to pick? They're going to pick the cute animals, they'll pick the charismatic megafauna, they'll pick the projects that sound cool or funny or have a direct, obvious application.
So, Save the Adorable Pandas gets funded, but a study of the molecular structure of a specific soil algae that might someday lead to a new antibiotic gets completely ignored.
Precisely. Even if the algae study is arguably much more important for human well-being, it's not sexy. It's hard to make a compelling video about it. Research on these platforms shows that humor and compelling visualizations often matter more than the actual scientific rigor of the proposal and getting funded.
So it risks turning science into a popularity contest, not a meritocracy.
That's the core fear of the scientific establishment.
What about journalism? I remember a platform called Spot.us years ago.
Spot.us was a pioneer, though it eventually closed. The idea was brilliant on paper. The public would fund specific reporting pitches from journalists. An investigative reporter could say, I want to look into corruption at City Hall. I need $5,000 to do it, and the community could fund that story into existence.
The upside seems obvious. Journalism that is independent from major corporate broadcasters and a direct bond between the reporter and their readers.
All true, but
But the panda bear problem rears its head again.
it does. Do we only get investigative journalism about topics that are already popular? Journalism often needs to cover boring, depressing, or complex things that no one would voluntarily pay to read about, but are absolutely essential for a functioning democracy.
And there's a conflict of interest question, too.
A huge one. If a specific group of donors funds you to write a story, do you feel beholden to them? Do you feel pressure to write the story they want to hear, rather than the one the facts lead you to? It's a very blurry line.
Real estate is another one that surprised me. I always thought you needed millions to be a real estate developer or investor.
Not anymore. This is one of the fastest growing sectors for crowdfunding. Platforms like Fundrise or Realty Mobile in the U.S. allow you to invest with as little as $100.
So what are you buying? A piece of a building?
Essentially, yes. They pool all that small-scale capital together to buy things like apartment buildings, commercial real estate, or even distressed mortgages. It's a form of democratization of asset ownership. It lowers the entry barrier to an asset class that was previously only for the rich.
And this is a global thing.
Oh, yeah. There are over 150 platforms worldwide now. China, the Middle East, France, it's everywhere. But again, the risks are real. Real estate is not a guaranteed win. If the market turns, that whole crowd of small investors takes the hit together.
Let's pivot to the human element here, the psychology of it all. Why do we do this? I get why a creator does it. They need money. But the notes suggest it's more than just the cash.
For creators, the money is often secondary to the validation. Think about it. If you put your idea on Kickstarter and 0 people back it, you've just saved yourself 2 years of your life and your life savings chasing a bad idea. You failed fast and cheap.
It's the ultimate form of market research. You're not asking people, would you buy this? You're asking them, will you buy this right now?
Exactly. And a successful campaign has what's called signal value. If you raise $1 million, that signals to retailers, distributors, and other investors that this is a hot product. It opens doors that would have been closed.
And it turns your customers into advocates.
Massively. If I back your project for $50, I am now invested. I want you to succeed. I'm going to tell my friends about it. I become your unpaid marketing team.
Okay, so that's the creator side. But what about the backers? Why do I give $50 for a cooler I might not see for 2 years, if ever?
There's a lot of psychology at play. Part of it is a sense of patronage, that feeling of being responsible for someone's success, for helping bring something cool into the world.
Like the people donating to the Statue of Liberty's pedestal.
Precisely. Part of it is social participation. There's a very strong herding behavior that's been observed on these platforms. As a project gets closer to its funding goal, the rate of funding dramatically accelerates. We like to back a winner.
It's FOMO, fear of missing out on the next big thing.
It's totally FOMO. And in equity crowdfunding, it's the lottery ticket mentality. Everyone wants to be able to say they put $100 into the next Apple when it was just 2 guys in a garage. The odds are terrible, but the dream is powerful.
But we have to talk about the risks for both sides. For creators, we mentioned the failure to deliver. But there's also IP exposure, intellectual property.
This is a huge risk for creators. To get funding, you have to show your work. You have to post videos, diagrams, and detailed explanations of your idea. Once that's on the internet, it can be copied.
And it happens.
It happens all the time. There are countless stories of copycat products appearing on sites like Alibaba before the Kickstarter campaign is even finished. Someone in a factory overseas sees the good idea, reverse engineers it from the pictures, and beats the original creator to market.
And the platforms, like Kickstarter, what's their liability?
Pretty much zero. Slava Rubin, the founder of Indiegogo, has been quoted saying, "We're not liable for any of that stuff. If someone steals your idea, that's your problem to solve in the legal system. The platform is just a venue."
That is absolutely terrifying for an inventor. But maybe not as heavy as the final sector we really need to discuss, medical crowdfunding.
This is where the topic moves from interesting economics and cool gadgets to a real societal crisis.
We've all seen the GoFundMe campaigns. Help my dad pay for his heart surgery. Help my friend cover her chemo treatments.
It has become a normalized, almost expected part of the healthcare landscape, particularly in the United States. But researchers who study this view it not as a triumph of community charity, but as a glaring symptom of a failing healthcare system.
I saw a quote in the research from the CEO of GoFundMe, Rob Solomon.
Yes, and it's a powerful one. He admitted, we shouldn't be the solution to a complex set of systemic problems. When the CEO of the fundraising platform tells you that the system is broken, you should probably listen.
And there are really difficult ethical traps here regarding this idea of deservingness.
This is the most uncomfortable part of the whole topic. To get funded, you need a compelling story. You need good photos. You need to be a good writer. You need a wide social network to share the campaign.
So if you are photogenic and popular and can write a heartbreaking story, you get healthcare. If you are quiet or you don't have internet savvy or your story isn't tragic enough,
You might not get funded. It creates what researchers call a socioeconomic gradient. People with higher status, better education, and stronger networks consistently raise more money. So instead of fixing healthcare inequality, crowdfunding can actually perpetuate it.
and the privacy cost must be immense. You have to put your medical records, your trauma, your worst moments on public display for the world to see and judge just to survive.
It forces a commodification of suffering. You have to market your pain effectively to strangers on the internet. It's a deeply fraught process for patients and their families.
Wow. That's heavy. But it's a necessary part of this picture. So let's try to zoom out and summarize this whole thing. We've gone from Joseph Pulitzer saving the Statue of Liberty with 15-cent donations to a potential trillion-dollar global industry that includes everything from potato salad parties to equity and skyscrapers to, tragically, life-saving surgery.
It is a mechanism that has fundamentally changed the flow of capital around the world. It allows for incredible things: art, inventions, games. Businesses that traditional gatekeepers would have killed in the cradle are now thriving.
Yeah.
It empowers the crowd in an unprecedented way.
It comes with significant baggage. You have the outright scams, the well-intentioned failures to deliver, the panda bear popularity contest problem in serious fields like science and journalism, and it acts as a systemic band-aid on a broken healthcare system.
It really is a double-edged sword. It bypasses the gatekeepers, but sometimes those gatekeepers, for all their faults, were there for a reason: to check facts, to ensure viability, to provide a safety net. When you remove them, you get the raw, unfiltered power of the crowd, for better and for worse.
So here's the final provocative thought I want to leave you with. If we are increasingly relying on the crowd to fund essential things, our journalism, our science, our healthcare, our legal system, are we actually moving toward a more democratic and empowered society?
Or are we just moving toward a society where the best story wins, regardless of the underlying need or the objective merit?
That is the question. Is it true democratization, or is it just a high-stakes popularity contest with a price tag?
Something to think about.
Absolutely. Thanks for diving deep with us today.
Thank you.